Trying to decide between a cash out refinance or a home equity line of credit or HELOC? Did you know that about 50% of homeowners don't know how to tap into their own hard-earned equity? In this video, we're going to be breaking down the pros and the cons of each of these options to make sure you make the right financial decision for the equity that you are owed in your house. Whether you're renovating, consolidating debt, or using those funds to invest, you need to know which one and which option is going to be best for your intentions for that equity. Hey, I'm Josh, and I'm a mortgage expert that helps homeowners unlock their equity the smart way. Today, we're breaking down the differences between a cash out refinance and a home equity line of credit or HELOC. This will help you determine which one is better for your situation. So here's the issue or the challenge. You know that you have significant equity in the house. You look at your property value like on Zillow, even though that may not be the right value, it's still a good estimate. And you know that you've paid your mortgage balance down to a certain amount. The difference between the value and what you owe is your equity. That is equity that you have built over time. You know that that is your hard-earned equity and you're ready to use it. There are many different options for using that equity, and two of those options are a home equity line of credit or a cash out refinance. Both can work. However, choosing the wrong option can leave you with higher interest rates, higher payments, lack of cash, anything that you may regret once you get to that closing table. Let's make sure you don't regret your decision and go through each of these options. The first thing you want to determine when you're going through these options is what are you using these funds for? If it's a variable of different things, so maybe you're looking at renovating your house, paying off some debt, reinvesting the funds, so a variable of many different things, a cash out refinance may not be the best option and a home equity line of credit will. However, if you're looking at one singular objective, then maybe a cash out refinance would be better than a HELOC. So what's the difference between the two? Let's start with a cash out refinance. A cash out refinance is going to give you the cash that you need up to a certain percentage of equity. However, this is going to affect your first mortgage. So let's say you purchased a house in 2020, 2021, and you have a really, really low interest rate. These are rates between 2s to 4s. That is a very low and great interest rate that if you do a cash out refinance, you are adjusting that mortgage and you will lose that rate. A cash out refinance is basically taking that mortgage that you have currently and making it into a new mortgage. So the cash out is going to pay off that current mortgage and raise the loan amount with a new interest rate and a new loan term in order to give you that cash that you need. So let's say that you currently owe $300,000 and you're going to do a cash out refinance and receive about $400,000. Your new loan of $400,000 would take and pay off that $300,000 loan, and you would receive the difference or that equity of $100,000. That would be deposited into your bank account tax-free. At that point, you would have a new interest rate, a new payment, and a new term based on what you negotiated with your new lender. You're also going to be likely paying a new lender. So unless you went through your current loan servicer, so for example, if you purchased your house through Wells Fargo and you refinance through Wells Fargo, there's a good highly likelihood that you're going to continue paying Wells Fargo. But if you purchased through a lender or a broker like myself and then went and did the cash out refinance with a lender or broker like myself, there's a good chance that you're already paying A company here, but that A company is going to be paid off by B company and you're going to be paying B company from here on out on the cash out refinance. Now for a home equity line of credit or HELOC. A HELOC is the term you're going to see online that stands for home equity line of credit. Now, this is a separate mortgage or a second mortgage. The first mortgage that you have will not be replaced by this HELOC. So if you have a low rate mortgage and a low monthly payment, then a HELOC is going to be a great option to not mess with that rate and payment. Now, you do have to have different credit score requirements. Generally, a 640 is the minimum for a HELOC, and the better the credit score, the better the terms. Now, however, a HELOC is a second mortgage, which means that the lien holder is taking on more risk. which also means the interest rate on your HELOC is going to be higher than what it would be on your first mortgage because of that additional risk. However, there's a lot of benefits to a HELOC that a traditional mortgage or cash out refinance does not offer. One of those benefits is that it's not touching that first mortgage. It's not paying anything off. It's not adjusting your payment, nothing of that sort. You're going to have a new lender and a new payment associated to that line of credit or HELOC. And it's exactly like it sounds. A line of credit sounds like a credit card, right? And that is exactly what a HELOC is against the equity that you have in your house. Now, a HELOC can give you access between 70% all the way up to 95% sometimes of your actual home equity in that second mortgage. Now, remember, the more equity you take, or the lower your scores are, your credit scores, the higher your interest rate and the higher your payment's going to be. Make sure you're communicating and understanding what those terms look like when you are working with a mortgage lender or broker like myself. A HELOC offers a lot of benefits in the sense of you're actually only paying for what you use. So similar to a credit card, if you have a home equity line of credit of $100,000, you have that line of credit. But let's say you don't need $100,000 right away because you only need $10,000 or $20,000 for a renovation. You can take that $10,000 or $20,000 out of the $100,000 that you have and only pay a monthly payment based on that $10,000 or $20,000. It's not going to be based off that $100,000 like a cash out refinance would be. Additionally, a HELOC is going to have what's called a draw period, a 2 to 5 year draw period typically, where you can take all the way up to that 100,000, but you don't have to. So if you only need 50,000, then you take that 50,000 between that draw period, and that's only what you pay. Additionally, on top of that, most of the time during the draw period, your payments are going to be lower based on just an interest-only payment. So you're not going to be paying any principal, but your monthly payment will be lower just based on the interest that you're paying on that 40, 50,000, even though the line is at 100,000. HELOCs are great to use if you're not looking to, one, mess with your first mortgage, two, if you're looking to do a lot of variable different things. So maybe renovate your house or invest in real estate or pay off and consolidate debt. You can use HELOCs in a number of different ways according to what works best for your situation. So as you can see, there's a lot of different variables that go into either picking. So as you can see, there's a lot of variables that go into whether or not you should pick a HELOC or a cash out refinance. The biggest thing that you need to ask yourself at the very beginning of this process is, what am I going to use that equity for? Again, if it's a lot of variable different objects, a HELOC may be a better option. Now, if it's a one fixed objective, like just consolidating debt, or you just need a lump sum cash out refinance may be the better option. Have questions about this? Comment down below or schedule a time with me using the link in the description. If this video is helpful, please like and subscribe. Thank you so much for watching. I'll catch you on the next one.